Inflation is like a silent pickpocket, steadily reducing the value of your money over time. While it may not feel urgent, its effects become painfully obvious as prices for everyday goods like groceries, housing, or coffee climb higher. The question is, can your investments grow fast enough to outpace this invisible thief? The answer is a resounding yes, but achieving this requires knowledge, strategy, and discipline. Let's explore how to protect and grow your wealth in an inflationary world. Understanding inflation, what are we up against? To understand how investments can beat inflation, it's important to first grasp what inflation is and how it impacts your finances. Inflation measures how much prices increase over time, typically expressed as a percentage. For example, if inflation is 3% annually, an item costing $100 today will cost $103 next year. While 3% may seem insignificant, its effects compound over time, diminishing the purchasing power of your savings. Imagine keeping $10,000 in cash under your mattress in 2000. 2 decades later, that same amount would buy far less due to inflation. What felt like a safe storage of value turned into a slow financial loss. This is why relying solely on cash or low-interest savings accounts is risky in an inflationary world. In most developed economies, inflation averages around 2 to 3% annually. However, during certain periods, such as economic crises or supply chain disruptions, inflation can spike significantly. This makes it essential to have a strategy to not just match, but exceed inflation's pace. How investments can outpace inflation. The key to overcoming inflation lies in choosing investments that grow your wealth faster than inflation reduces it. Some options consistently perform better against inflation than others, offering the opportunity to not just preserve, but increase your purchasing power. Stocks have proven to be one of the most effective ways to beat inflation over the long term. Historically, stock market returns average between 7 to 10% annually before inflation, translating to Forbes 7% after adjusting for rising prices. Stocks perform well because businesses can raise their prices during inflationary periods, keeping their profits stable or growing. This ability to adapt makes stocks a reliable long-term ally for investors. For instance, if you had invested $10,000 in a diversified stock portfolio in 2000, your investment could have grown to over $38,000 by 2020. A stark contrast to the stagnant value of cash hidden under a mattress. Real estate also provides a strong defense against inflation. Property values and rental income typically rise alongside inflation, making real estate a tangible and reliable asset. Imagine purchasing an apartment for $200,000 in 2010. By 2023, that property might be worth $300,000, depending on market conditions, while your rental income has likely increased to reflect higher living costs. Unlike stocks, real estate offers a blend of price appreciation and recurring income, making it a dual-purpose investment. Bonds, often seen as safe and stable, have mixed effectiveness when it comes to inflation. Traditional fixed-income bonds may struggle to keep up, as their interest payments remain the same even as prices rise. However, inflation-protected bonds like U.S. Treasury, inflation-protected securities, TIPS, adjust their payouts based on inflation rates. These bonds offer a straightforward way to ensure your returns aren't eroded by rising prices, though their overall growth potential is lower compared to stocks and real estate. Commodities, particularly precious metals like gold, have historically been go-to options during inflationary periods. Gold, for example, is valued for its ability to hold intrinsic worth regardless of economic fluctuations. Between 2000 and 2020, gold prices rose from around $280 per ounce to over $1,800 per ounce, far outpacing inflation during the same period. While commodities are excellent for hedging against inflation, they don't generate income like stocks or real estate. making them a complementary rather than primary investment. For those who prefer a simpler approach, diversified funds such as ETFs and mutual funds provide a practical solution. These funds pool a variety of assets, reducing the risks associated with investing in individual stocks or bonds. Options like the Vanguard Total Stock Market ETF (VTI) or dividend-focused mutual funds offer a reliable way to achieve inflation-beating returns with less effort. Common pitfalls to avoid: while investing to beat inflation is necessary, certain mistakes can derail even the best plans. Relying too heavily on low-yield savings accounts is a common misstep. These accounts rarely offer interest rates that keep up with inflation, guaranteeing a loss of purchasing power over time. Overconcentration in a single type of investment, such as only owning stocks or only investing in real estate, is another frequent error. Diversification is critical to balance risks and returns. High fees and taxes on investment gains can quietly erode returns, so choosing low-cost funds and optimizing for tax efficiency is essential. Reacting emotionally to market volatility is another major pitfall. Selling investments during a downturn locks in losses and can prevent you from benefiting when the market recovers. Crafting your inflation-beating strategy. Beating inflation requires a thoughtful plan tailored to your goals, timeline, and risk tolerance. Begin by clearly defining what you want to achieve. If you're saving for long-term goals like retirement, you can afford to take more risks with higher return investments like stocks. For shorter-term goals, safer options like inflation-protected bonds might be more suitable. Diversification is essential. By spreading your investments across stocks, real estate, bonds, and commodities, you reduce the likelihood that a downturn in one area will significantly impact your overall portfolio. Regularly reviewing and adjusting your portfolio ensures it stays aligned with your goals and adapts to changing market conditions. For example, during periods of high inflation, increasing exposure to stocks and real estate may help offset the declining value of bonds. Consistency is another key factor. The power of compounding works best when you invest regularly and reinvest returns, even during challenging market periods. Avoid trying to time the market. Instead, focus on long-term growth and discipline. The path to staying ahead. So can your investments really beat inflation? Absolutely. The right combination of stocks, real estate, bonds, and commodities can not only preserve your wealth, but help it grow in the face of rising prices. Success lies in diversification, consistency, and staying committed to your financial plan even during market fluctuations. Inflation doesn't have to be a silent thief. By investing strategically and staying focused on your long-term goals, you can turn the tables, ensuring that your wealth grows and keeps pace with the world's changing economy.